So from an 80% subsidiary become associate. So they want type C. So when investment to trade, subsidiary to trade investment, same thing here. B controlling sub, for example, 80%. Now you sold off 70%. So you left behind 10%. So just become an investment only. Or you call it trade investment for trade. So from a subsidiary, you become trade investment. So all these three types, loss control ones, accounting treatment are different. So you have to understand and remember which type of disposal you follow, which type of accounting treatment. So that's why you make this topic complicated, and sometimes it will be confusing. So you don't know. First, you must decide whether they lost control or not. If you lost control, then you see whether you follow A, type A, B, or C. Okay. Then you have one more types when you lost, when control is retained. So control is retained. So retain means you still have control. It means still your subsidiary. So this is a simple like P controlling S. So you got 80%, so you sold 20%. So you have 60% remain. So still a subsidiary. Okay, so this is the when your control is retained, you still a subsidiary. So treatment are different. So today we will go through all these different type of disposal. Okay, up to here, any questions? So then you will realize that this is actually the opposite of step acquisition. From 0% you buy 80, from 30% you buy 50, you get 80. From 10% you buy 70, you get 80. Okay, you go up, now you go down, dispose of. So in here, increasing now is reducing. Okay, now we know all these four types of disposal. Then we have this. We learn step by step which one is more important. So this one I won't go through it. Now we already explained. So let me go back to the page. So when you have, then you will dispose. Okay, when you dispose of course you have to sell something. So you might have consideration received, money you receive, right? So because you dispose, may have received some money. Then let's say you have 80%, you dispose of 40%. Dispose. So your 80, you keep 40%. Okay, the fair value of retained investment. If you keep the 80, you sell 40, you keep 40%. So you have NCI also for 20. So this is all your. You look at this, you look at very similar to your goodwill computation. Except your goodwill, you pay money, consideration pay. Now this time you consideration receive. So you got fair value retained. Remember, you have step acquisition, you buy 40 and you buy another 40. It's the same. NCI at the day. So this one must be at the day of disposal. Okay, we compute gain or loss on disposal. And when you sell off you receive the money, so you must less your net asset. Same like your goodwill, your goodwill computation, you will also less your goodwill. Because now no more your subsidiary. You dispose of. The 80% become 40%. So this one is loss control. So control is loss. Okay, it will be in your control is loss here under subsidiary to associate. So for 80% become 40%. 80% subsidiary become 40. Control is loss. Then you minus certain assets. So you minus the goodwill, then you have a gain loss on disposal. Then you go to your P&L. Control your loss. Okay. So basically it's same like here, but this at the console level, but at the parent level. Okay, at the parent level. At the parent book, it's just how much I received the money, contribution received, and how much is the value I bought it. The difference equal P&L. This at the parent book, but not at console. Okay. So let's say I bought a subsidiary at 10 million, now I sell it for 12 million. So I make 2 million. As simple as that at parent level. So now we go for when control is lost. Okay. First type is full disposal. This how control is lost is partial disposal. I'll give you an example here. I'll give you one more in a full disposal. So for full disposal, so they say dispose of everything. So then you don't have this column only. The rest are the same. So you dispose all the 80%. Yeah, gain loss. So this is the partial one. Partial from subsidiary to associate. And full disposal for that. So you realize that the only difference is the column here. So you have, because you still keep it, still retain the percentage you have. Subsidiary to associate, 80% subsidiary to, for example, this case is 80% subsidiary to dispose of. I said 50% easier, that's 40%. So you have 50, dispose 50, so you keep 30. Change up easier way, 240 you confuse them. So here full disposal, let's say you have 80%. So you minus all the 80%, you dispose everything, go to new. So they didn't keep the 30% here. So we have full disposal easier, like P&L side, you console up to the date of disposal. Make sense? So it dispose 1st July 2021. So then you have computer group dispose profit and loss like here. Okay. So this is the theory part for in the SOFP statement of financial position. So you got to dispose of no more NCI and no more consolidation and no subsidiary. The whole subsidiary dispose of full disposal. Like here 80% you sell off everything, 80% you get new. Okay, when the partial disposal, they have two types, subsidiary to associate. Like given here, 80% become 50. So what will happen is, so treat the undertaking as a subsidiary up to the day of disposal. Okay, up to the date of disposal. First is disposal, but Then after that, you become associate already. Okay? And show profit and loss on gains, then you treat the associate thereafter. So you associate one, you must do equity accounting, share the post-acquisition retained earning. That's why you need to know the basics. So here, you remain 30%, so you have to do equity accounting. Separately, so you have the cost of investments, I think 30%, how much? And you plus post-acquisition profit. This is called equity accounting. So SYP. So this amount you total up, you show in your SYP. So this amount, share of post-acquisition profit is charged to P&L. Okay. So you then go to SYP. Go and do it. Statement of profit and loss. Get console. So it's called equity accounting. The investment remaining, so what you still keep one, the 30% you show as fair value at date of disposal. Okay. Same like the one when we compute goodwill at date of acquisition or fair value. By disposal, at date of disposal, all the fair value items. Consolidation, fair value retaining, fair value NCI, fair value net assets. So the next one, subsidiary to trade investment. One more example here. Subsidiary, also partial disposal, but this time subsidiary to trade investment. So we'll give you the example later, give you the theory part first. So this one you can be, let's say the 80% you have, so you minus 70%, let's say. So you get 10%. So 10% less than 20, not even an associate. So remaining 10% here you keep. So you show off 20%. So this become trade investment rate. And fair value at the of disposal. So this one subsidiary to trade investment, similar to subsidiary to associate. Only difference is you don't need to do equity accounting because it's no more associate, 10% only. But in the first case, you have 30%, you do equity accounting when you are subsidiary to associate. So you have the familiar with all these three types, the computation of gain loss. So then the fourth type is when control is lost. Then no more a subsidiary. Sorry, when control is retained, basically from subsidiary to subsidiary. So in this case, it's control fully. Okay, but as long as still your subsidiary, add or asset across altogether, liability or add across parent plus subsidiary, the revenue, the cost, all add across in P&L. But only come to your NCI in your P&L, the bottom part, profit attributed to the NCI. So just time portion. Maybe first 6 months of the year, NCI 20%. Second 6 months of the year become 30%. Just time apportioning. So in this case, you remember, no profit and loss on disposal. So the first three one, this control loss, you have gain loss on disposal. See? Not when you have control is capped. So you got here 1, 2, 3 here. Okay, so now when you control a loss, easier, like similar what we learned in the step acquisition when control is retained. So when control is retained, I mean still a subsidiary. So this is normally can be 80% subsidiary, you minus 20%, so become 60% subsidiary. So in this case, they said it treated a transaction between the owner, between the parent and subsidiary. So when this, you need to pass a journal entry. Very simple. So when NCI, in this case, you sell 20%, 80% minus 20 get 60. So the NCI will increase it. So NCI increase, you will be credit. NCI in this case, like here, 20%. So credit NCI, 20%. So when you sell it, you receive money, right? So you debit your bank. Any difference, let's say it's the debit more, so you go to other component of equity, OCE, is the balancing. The balancing can be debit and credit. How you do it? As simple as that. Okay, when you have control is retained. So remember these three entries, okay? Like for example, let's say we have, okay, the NCI is valued at 20%, is 20 million. So I sold it for 80 million. So different 2 million, debit to OC balancing. I said NCI 20 million, I sold it for 24 million. So in this case, we'll change here, it will be credit. Balancing here, 4 million. So the tricky part of it, you must know how much 20% NCI is the value of it. So you have to compute the NCI. Let's say come to here, you have 20%. Okay, so you must find 20% of your net asset will be your 20% NCI if the company using partial goodwill. So in this case, no change in your goodwill computation. Okay, unchanged goodwill. Then NCI is treated as adjustment to parent equity. So the 4 million here is adjustment to equity. Okay, then the easier way to understand better is do some questions. So example 3.8 here. Okay, petrol company bought 100% share capital, so that we can write here. So we write it down so we can understand better. So this is petrol. This is petrol here. 100% on 1st January for 160,000. So dear company earn and retain earnings in rate 240,000. So this is a pre-acquisition profit. Okay. So they acquisition 1st January, they pay 160. So in here, in fact, you can compute goodwill. Okay. So until X7. So from X2, they bought it all the way to X7. So they given you the petrol and Sedia consolidation. So the console level as well as individual company level. So the group profit NCI using proportionate share of fair value. So this is partial goodwill. So on 1st January, Petrol sold 40% shareholding in Sedia for 280. They sold 40% of it. So then how much they keep? So they sold 40% of it. So they're keeping 60%. So this one is retain control or lost control. So you're still keeping it, 60% of it. So it's still your subsidiary. Okay, so 100% subsidiary become 60% subsidiary. So then it's easier that they sold it for 280,000. So at the parent book level, okay, so your parent side is just because you sold it for 280, so you have a received 280. But the value, you remember you bought 160. For 100% is 160. So 40%, 160 will be to your cost, 64,000. So the difference, 216 profit on the sales of subsidiary at parent book, at petrol company, not at console. Okay. So because this is only 40% disclosed of the 100% subsidiary has been sold, so leaving 60% control is retained. So as I explained here, chart 100% subsidiary book with you 40%, you got 60. So in this case, your control is retained. So you in your type 4 here, this type when control is retained. So in this case now is 40%, 100% become 40. Okay, you can change it a bit, 100% minus 40 plus 60. So when you show off the 40%, it must be how much? 40% here. And so for how much value? So we sold it for 280,000. 280, you receive the money. So this means that the parent, there is no group profit on disposal. No profit on disposal, just pass this entry unit, okay? Because they treated a movement between the owner, NCI, and parent. So anything you charge to parent equity means you charge to OCE. Okay? So in this case, the 40% NCI is 160,000. So you get the net asset of the subsidiary. Will be your net asset subsidiary will be 160,000 share capital plus retained earning 240. So 400. So 400 times 40%, 160. So then here the NCI of 40%, 160. So the different balancing be 120. So we pass this entry in your console, of course, it balance. So the rest you just add across, other asset add across, current liability add across. Get investment in Sedia, you contract off and you compute your goodwill. Up to here, any questions?
May I ask why the NCI is 160?
Okay. So remember,
Hello?
NCI, yes. So I just explained the NCI is based on net asset. So you have net asset. The net assets, remember we compute the asset is share capital, correct? Share capital plus retained earning. At day of disposal, 160 and 240. We add up these two. So total net asset up to here, understand? Net assets 400,000 from here.
Yes.
So here, then we want to NCI, we times 40% here. 160. Okay. Remember, you compute your goodwill using same method. Understand?
Yes, understand. Thank
So
you.
your 160, so your 40% NCI value at 160. But this guy pay you 280,000. Receive money, you debit back. So when you go NCI, you sell it off to NCI, parent sell to the NCI. So NCI increase, so you credit NCI. So the difference, go to balancing, go to OC, other component equity. In this one, they call it parent equity. This is a parent equity. So there's no impact on P&L, no impact on goodwill. Okay, remember, my control regime goodwill unchanged. Unchanged means when you first gain control, compute goodwill, that's it, keep it there. First gain control. When you, in this case, 100% at the time you get. Okay, and no gain loss on disposal. This will test you, will test pretty easy, test you this one. I think in your final. Okay, remember these two things when control is retained. So unlike when control loss, you have gain loss or disposal, goodwill will write off. Okay, goodwill written off here. Then no more control. You lost control. Okay. So when you do control easier, just add a cross. So your goodwill is 96 at the parent level, not the investment in shares. You got 160, you sell off 64 with 40% of it. Okay, 40% 160, 64. So 160 minus 64, you got 96. So this is your remaining 60% of 160, you got 96. Okay, then you do console, you just add a clause, other assets, parent plus subsidiary. Share capital, you just take the parents. Retained earning, you have to do it the parent plus post-acquisition profit. And other liability, parent plus subsidiary. So you got your NCI 160. Okay, where you get the NCI from here, remember? The 400,000 times 40% NCI 160. So think about it. Any question? No? Okay, so now what will happen is, okay, using the above example to make the thing more interesting. So assume Petra sold 60% of its holding for 450. So instead of selling 40% here, now we change the questions. Okay. So instead of selling 60%, selling 60% of it now become 40%. So this regain control or lost control. So the control is lost because for 100% subsidiary become associate. Get no more subsidiary, become associate. 40% associate. So this is which type of loss control we have. Here, partial subsidiary to associate. Okay, this is the portion of it. Okay, in this case, partial is in this question is they have 100%, change to 100%. So they sold off 60. The question said instead of 40, so we have initial 100, 60. So the NCI will be in 40. So in this case, you sold off 60%. But previously held, you have 40%. NCI here 0 because initially you hold 100%. Then 60, 40 here. Then you have minus the net asset minus the goodwill written off. Okay? Because now we sold off to 60%. So they sold the 60% here for 440. So we change it to 440. 1,000. So fair value of 40% holding retained is 200. So here we've been 200. So we don't have NCI because 100% control. Then you have this, then you find the net asset at day of disposal. Remember the net asset we have computed, just like asking you have 400 here. So you dispose of, the net asset is 100%. So here will be 400. Check calculated by retained earnings minus 400. Okay, in this case, they do have goodwill, so you just add the cross. So the gain loss is 240, as given here. In this case, there are no goodwill arising acquisition of subsidiary. Okay, give you time for you to think, digest. So easy, just fill in the gap only, right? So this format is important. Okay, remember how to do it. So when you have loss control, in this case, loss control is the subsidiary to associate. Become associate status. So in this case, you don't have to console this case because now it's associate. Okay, the share associate profit on the 40% of it. Like here, the accounting cost of investment associate now is 40%. Is how much? In this case, it's 200. So poor acquisition, but we haven't started doing yet because it's the disposal off on the date of year end. Okay, 31st December X7 is sold off. Then 1st January X8. So X7 you still have to consolidate. The next day then sold off. So you de-recognize it on the 31st December X7. Very last day. So this is at the parent level, 64, because you sold off 160 value, you sold off 60%, you keep 40%. So it's 64 in your note 1 here, okay? So asset is can add across for console because it effectively 1st January X8 you go off, sell off here. Okay, on 1st January X Petrol sold 40% shareholding. So at group retained earning 800 as per parents plus the gain on disposal 240 here. Okay. So you get 1040 here. Okay, because at this time still 100% subsidiary, so if I no NCI. Only 1st January X8 that is full. Okay, no question. You go to one more example here. Giant call, okay. So I show both Excel and in words so that it can easier for you to follow. So in this case, Giant bought 80% share capital of Subsidiary for 324 on 1st October. Then easier, my practice is to write down the group structure, simple one, just beside the question so you can follow easily. So in this case, Giant, then you know these parents. So they bought Subsidiary. So 80% mistake, 1st October X5. Okay, they pay 324,000. So we have compute goodwill. So we have goodwill computation. Here, like goodwill consideration, 334,000. Okay. And now we continue. So we keep earning 180. So put there 180. Okay. For goodwill computation, remember goodwill computation is consideration plus NCI minus net assets. Okay. And the year 30th September X8. So about 3 years later. Okay. So they've given you the P&L and the as well as the SYP for Giant and Subsidiary. So first part is SYP. Bottom they give you a 3 lines P&L only. Profit before tax, and profit after tax. Okay, the question telling you is no entry has been made for account for the foreign transaction. So they haven't done these transactions yet. So you have to pass this trial transaction. Okay, assume profit accrue evenly. It means it's something that happened during the year. You have to do time apportionment of profit. That's why they say assume profit accrue evenly. Is the group profit of value NCI? Proportion share of fair value. So we know this is the partial goodwill method. Okay. So from here then you can, because you have to buy a subsidiary first, so you have to compute goodwill. So from here then we can compute goodwill first. So we know the consideration. So the partial goodwill, share capital given here. Share capital subsidiary 180. So 180, then you use your total asset. Will be 180 share capital, 180 retaining, 360. So a proportional share of net asset NCI 360 times 20%, you got 72. A goodwill of 36. So you must first have your subsidiary when you buy before you can sold off dispose. The same goodwill computation still valid in disposal of subsidiary. Same thing for step acquisition. So then you must learn and familiar with how to compute goodwill. Because almost certain you will come up for all console questions. Because you need a subsidiary to do console. Okay, as simple as that. So now we come back to the question here. So this question is very comprehensive example. So what the required for us? Prepare consolidated SOP and P&L. The dear September X8. So first one, A, Giant sell entitled holding for 650 on 30th September X8. You sold everything. So this is full disposal. So here we summarize here. So then we know this is, we call this full disposal, first one. So dispose of everything. So you get 0%. So this is A, for the scenario here, full disposal. Okay, on 30th September X8, so at year end. So they sold 650, so 650. So in this case, definitely a loss control, 0%. So then we must, with a loss control, we must compute gain loss on disposal. So like here, full control A here, full disposal. So it sold off for 650. So it didn't keep anything 0% new here. Okay. Then we compute net asset up to the day of disposal. So net asset of subsidiary 180 for share capital retained earning 360 given here. So add up 540. So 100% you sold off everything. Okay. 540. But proportional to net asset is because you have 80%, 20% are subsidiary. So this is how you 140 times 20% got 108. So proceed plus NCI, because you didn't keep anything, you sell off fully, minus the net asset 540, you get 218. Then you will write off your goodwill 36 here. So you lost control, you get 182. Bro. So can you follow? Any questions? So 36 here come to here, write off. Okay, if you use it just now the example, the format, full disposal. So we have 80%. So we sold it off. Entire holding was 650. Okay, we keep 20% of it, but before that we found the net asset is how much? The net asset is 180 plus 360 returning 140. So here 20% of 140.2. So here's here minus. So your goodwill, remember, we have decomputed is 65. 36, sorry. Minus 36. 182. So then you must know which type of disposal, okay? 182. Okay. So let's have five-minute break for you to digest this. So you read out whole question, style level. You see the first one. Sell is entire holding to secure 650. So before I go to the B and C and D, which is much more complicated. Okay. So you have time for you to digest. No point going on. Continue if you don't understand the first step. Okay. there any question on the part 1? Do everybody understand? Okay, now we go to the part B. So if Giant sell 1/4, 1/4 of his holding. So we have 80%, 1/4 mean 20%. Okay, for 160 on 30th June. This 30th June is not the year end. Year end is 30th September. So from June to September, 3 more months. So in other words, first 9 months, you are the 80% subsidiary. The balance of 3 months, July, August, September, you only have 60% subsidiary. He's selling 1/4 of his holding. 1/4 of the 80% means 20%. So this is which type? So 3 types here. Subsidiary to associate, full disposal, subsidiary to trade investment, or when control is retained. So when control is retained, because this is 80% subsidiary, you sell off 20%. So you become, in this case, it is your 80% subsidiary. You can change it to 80% subsidiary. You sell off 1/4, means 20%. So you still have 60. So that means goodwill unchanged. When you first gain control, still remain. No gain, loss, or disposal. So you just pass down this entry unit. So they say sold 160,000. So you change it to 160,000. So to find out your 1/4 one, in this case 20%. Is how much the NCI? Okay, at 30th June. So first, then this is we come back to this. So this is partial loss control, retain control. So this B is retain control. Okay, it's a movement from you sell 20%, 1/4 of the 80. So you still keep 60. You sell 160. So as a parent book, 160 is sold off. So you cost you 81,000. Remember, we bought it, the parent bought it as 324. You can see from here. I bought it. So then you can times the, so 20% of it. So this is 80% of it, of the 20%, 1/4. Okay. Follow. This is as parent book. So this is addition information for you. So we are in parent book, you got 79. So the 20% of the NCI. So first we will find out the net asset at their disposal. How much first? So it proceed here 160. So your NCI decreased by from 20%, you sell off 20%. Increase the NCI. So how you compute the NCI at their disposal? First, at acquisition is 72 NCI. Where is from here? Okay, 20% of 360 at acquisition when you compute the goodwill, 72. Then we have retained earning at 360 as per SOP of subsidiary company. Then you minus last 3 months, because you only acquired on 30th June. 3 months, means July, August, September are excluded. to arrive at the up to 30th June X8 profit. So your whole year profit is 90. Okay. What's the deal? So 3 over 12 is 22.5. So 360 minus 22.5, you are 337.5. Then you minus your 180 pre-acquisition profit, so you get post-acquisition profit. Priority given here, retained earning. So you get balance post-acquisition profit at 157.5. So 20% of the NCI sold off, 1/4 of it, of the 80. So you get 31.5. So the cumulative NCI acquisition plus post-acquisition profit, you get 103.5. So this one will be a bit complicated because it's disposed within during the financial year in the month number 9. So you have 12 months in the financial year. In this case, the year end is 30th September. So from 1st October X7 to 30th September X8, the financial year end. Okay. Well, this you can see I think you have they have a timeline here. Okay, timeline. So whole year subsidiary, everything is NCI for the first 9 months is 20%. NCI for the remaining 3 months is 40%. So you have to compute your net asset up to 30th June, which is 103.5. So you have 540. This alternative way, minus your 3 months and 20%. So this is same with what I have here, 103. They're using a cumulative, are using the normal NCI method, acquisition plus post-acquisition profit. So the 540 here, they're using the net asset here. $180, $200, but proportion up, take up the 3 months here, profits. Okay, any question up to here? Is it challenging, huh? So 540 is from here. 180 share capital, 360 retained earning. You take out the 3 months, you get 103. After you times the 20%. So then we found this then easier, then you compare 103.6 right here. So inside 20, 103.5. So the difference, you go to your OC. So 56 here, same here. Okay, these are entries. So when the control is retained. So goodwill unchanged, still your original figures, 36. No gain loss on disposal. Okay, Jing Hong, Qin Jing Hong. Can I speak to you? Jin Hong. Apparently not here. Jia Wen, Ng Jia Wen. Can I speak to you? Jia Wen. Those people didn't hear me or didn't listen. Jackie Kong, are you here? Jackie, can you follow?
Yes.
Okay, now we'll just test you a bit. See here, okay, Zaya sell 1/2 of the holding to Sedia for 340. So this is loss control or retain control? one half means 50% of it. Number C. So they lost control or retain control? Here. Which one? Lost control or retain control? Lost control from which one? Here, lost control got 3. Partial, subsidiary to associate, full disposal, or subsidiary to trade investment. Which one?
Partial.
Sorry? Partial subsidiary to associate. Okay, good. So in my understanding, you will get it wrong, you don't know how to compute. So you have to follow this method already. Okay? Partial. So there you have original 80%. Now we sold off half of it, 40% of it. So we sell 40%, so we keep 40%. So you have 20% NCI. So you keep on the number. So on 30th June, so you sell one half of it, you sell at 340. So you said for 340,000 here. So they said the remaining holding in 250. So you keep the remaining 250. So the NCI just now we already computed the 20% of it. How much? Okay. So the net asset you also computed right off the goodwill of 36. I remember 36. Okay. So you use that partial. Then you come to here. This is number C. This is partial. So you proceed 340 given here. Remaining 260. So NCI just now we computed 103.5, 20% here. So you minus your net asset 517.5 net asset up to the day of disposal. Then you write off your goodwill 36, you have 140. So the net asset you can, as show, you can use another method. You're using the 540. Here you minus 3 months profits. Okay, 540 minus the 3 month profit, so that you have a net asset up to 30th June X8. Okay, that is so a timeline here. So first 6 months is first 9 months is 80% subsidiary. When you sell off one half of it, you become 40% associate. Last 3 months. Okay, sell 40%. So then the remaining equity account for it. In this case, you have to compute gain loss on disposal, exactly right here. So you have to do equity accounting. So you have here equity 250. Meaning to share the 3 month profit here, you can share 40% of it. Do you have any question? This is considered the most complicated from subsidiary disposal become associate. So you must know how to console the 9 month subsidiary and equity accounting for associate. So it tests you 2 topics: subsidiary consolidation and equity accounting and disposal. So the disposal given here, the format is same with my Excel. So you saw 340 to February 250. You use the format 350. So your net assets are 517.5. You 540 full year asset minus your 3 months. Okay, profits 90,000, 3 over 12. 90 is the whole year. So you write out goodwill 36. Okay, and your NCI will be 20% on the 5172. 517.5 times 20%. 103. So you get 140. Lai Yok Hui, can I speak to you? Lai Yok Hui. Okay, apparently some people are not around. Okay, wait, so it off now. Yes, okay, yes. Good, you're here. Any area to understand? Okay, you don't ask you question. So part D here, so we sell 1/3 of shareholders today for 340 on 30th June, and the remaining holding 250, but this one is treated as an equity investment. So this is retain control or loss control? Part D. Lai Yu Hui. Sorry? Retain control or loss control?
Retain control.
Retain control. Why retain? You sell 1/2 of his holding. So Jaya, before you dispose, hold how many percent of Subsidiary? Hold how many percent?
2/3.
80%. You bought 80% of Subsidiary. Now we sell off 1/2, mean half of it, 40%. 80% sell 40%. Remaining how many percent?
40%.
Yeah, so this is loss control or retain control?
Loss control.
Yeah, loss control has 3 parts. Which one? Partial, full, or sub to trade investment? So you must know this which one to go. Otherwise, the 3 accounting treatment are different. You compute the gain, loss, or disposal. So this one is a sub to trade investment because the question here deal with as an investment in equity instruments. So number 3, sub to trade investment. So in this case, 80%, you sold off half of it, 40%. So you get the 40. But the 40, you do have significant influence, just an investment. Investment. Okay? So doesn't mean 40% you become associate. But here in this case, they clearly say that it's an investment in equity instrument. It's not an associate. Associate is C, not in D. Okay? Okay, thank you. So if this is treated as equity, easier. So you have original 80%. So you sold off, you will give 40. You sold off 40, you give 40, and inside is 40. So you sold off this for 340, 40%. So you keep the remaining fair value 250. So the net asset just now we have computed 517.5. We write off the goodwill because of loss control. 36 we have computed. So the NCI is 20% of 517.5.2. So you can compute your gain loss on disposal. So 140. Okay. You can show here the full working are given here and with explanation. This partial subsidiary to associates, how we are part C, how we doing part D. So subsidiary become equity instrument, mean trade investments. So first 6 months is subsidiary, next 6 months it becomes a trade investment. Investment instrument EI, okay? So you have 140 here. Let's see here. Where I compute. So the 30th profit have to compute until 30th June. Okay, so say minus 3 month profit here. 90,000. So this summary you must remember is, so you must know the effective date of disposal when control is passed. Okay, you loss of control or still retain. So how you treat your goodwill. Okay, you must know what type of disposal, full or partial. Okay, become subsidiary, become associate, become investment. When you control your loss, so the retain is fair value, then you compute gain loss. When you control is still retain, no gain loss, no goodwill change. Okay, everything adjustment to the parent equity. Means you pass through the general entry here, the 3 entries only. So this 3 entry will be tested. Okay, so because easy, you will test you subsidiary to associate. I think is the failure rate will be much higher. Okay, see, test your understanding, whether you understand what I'm talking about. So you have to, I'll let you try this online questions. So I send you the link. You should get, just log into the link. So this online question, they make it simplified, short questions. So then it guide you. Most of it are objective. So for you to understand the basics. So we take a break. So come back at 12:45. By taking a break, please complete these online questions. So from the online question, you can see that I actually given you this mind map. Okay, type of disposal, control is retained, control is lost. So if you've forgotten what I told you, so you should read to which one is referring to which question they have disposal. Okay. So when you know this, which type of disposal, control retain or control is lost, then you go to treatment, how you do. So when you full disposal, the treatment given here. Subsidiary associate treatment given here. Subsidiary to investment are given here. And the format are given here. So here you will less NCI, you can just add NCI on top, easier. I follow the goodwill method format, easier. Okay, so you won't confuse. So when you do a group retained earning, you see before and after disposal, the subsidiary, the S. Okay. So this is the parent book, easier. Money you receive on disposal and the carrying amount of investment at parent books. So then I give you the summary of keynotes. So when you subsidiary associate, what will happen here? Okay. And subsidiary investment, what you need to do. Then you can continue. Okay, the question is rather short, but it helps you to get a basic understanding. So please start doing this. You come back at 12:45. Okay, let's discuss the online question. Okay, there you can see. So this is disposal. So make sure you're familiar with the type of disposal we have. Okay, so you have control is retained and subsidiary to subsidiary. When control is lost, so there are three types: full disposal, subsidiary to associate, like given here in the Excel, and subsidiary to investment. Okay, now we go for the first part of question. Let's see who submitted one. Okay. Yi Chuan, can I speak to you? Pang Yi Chuan. Pang Yi Chuan. Are you in?
Yes, sir.
Okay, let's go through your questions. Okay. Online. So first one, PA own 90% of MG to sell 50%. So your 90% sell off 50%. So you have 40%. So this is a partial loss control subsidiary to associate. Okay, so it's correct. Okay, then this is what type of disposal substitute is retain control? Yes, substitute to substitute. So this first part of this will test you how you identify types of disposal. Okay, so in the structure question or the theory question, so you must know which one so that you won't go out of control. Okay, in this case you see that is sell 50%, so partial disposal. Now we have it sell 50%, so we type here 50%, so you will keep 40%, so NCI is 10%. So the 50% is selling for 120 million. So NCI is 53, they're saying. So the fair value of remaining 40% is 96. So I use the Excel here. So that goodwill originally is 38. So net asset disposal 201. So the minus net assets 201. Goodwill you write off because no more your subsidiary 38. The gain loss of 30. Okay, so you must know which format to choose. Then control is lost when there is a disposal, not necessarily when you have retained control. Okay, like the 80% minus 20, 60. That's why it falls. So calculate the gain loss on disposal. Gain loss the disposal each one. So you know where your mistake here?
I use wrong percentage.
Wrong percentage. Okay, we wash out your percentage. Okay.
Because I think that the 50% is the 50% of the 90%. I see the question only.
Okay. So you read. Okay, good. So the 50% of each investment. Or you use the half of the 45% that you use.
Yeah.
Okay.
I see the question only.
Oh, okay. Understand. So at least you understand why the next time you be more careful of reading. So this one quite a number of students get it wrong. So because which of the following accounting treatment in respect of disposal of 50% of energy is false. It means they want you to find out the wrong answer. The wrong answer is the correct answer. What is wrong? The first one, treatment undertaking as a subsidiary up to the day of disposal. Yes, up to the day of disposal, you still subsidiary, still 90% subsidiary. So first one is correct, but for this answer is incorrect because they want the wrong answer. So compute gain loss, yes, this is correct. So this is wrong. Treat the remaining as an associate using equity accounting. Say 40% is considered an equity, is an associate. So this is correct. You see here, equity accounting, cost of investment plus pool absolute profit. So we said we did 20 to 50%. So the answer is none of the above is correct. So that means none, all these are correct, mean none of the above is, because this is correct, it means it's a false, this statement. That can be quite confusing the way the question been asked, okay? They want you to find out the wrong answer. Okay, understand? So next one. So PA disposal own 90%, and before he decided to sell 20% investment. So 90% here, he sell 20%. So this is retain control or loss control?
Retain.
Retain. So retain control, you need to pass these entries only. Okay, the journal entries. So they sell 20%, so 20% of it, they sell it for 50. So they say when you ship bank or receivable, so debit bank receive money. Goodwill original is 50 here, so it's unchanged. But net asset is 150, so you need to compute the net asset here. Here, so that instead of the breakdown, they give you a total 150. You have to add in the goodwill. Okay. So 200 here, so the NCI now is selling 20% of NCI, so you change to 20%. So 400, so 200 times 20%, so it's 40. So 40 here, NCI reduce, increase, so the difference 10. So this is how the journal entry. So now we test you theory. Which of the following accounting treatment are correct for disposal? So the subsidiary consolidated in full for the whole period. This is wrong because the subsidiary consolidate. This is still retain control. Sorry, this is correct. So still a subsidiary from 90% subsidiary change to 70%. So as long as you're a subsidiary, we do the full consolidation. This is correct. NCI, correct, based on before and after. So before one, you have NCI 10%. Now the NCI becomes 30% after the disposal sell of 20%. So profits and loss, no profit and loss, correct. No profit and loss. No gain loss on disposal, goodwill unchanged. So the change increase in NCI is shown an adjustment to parent equity. So this is correct. Then we charge to here balancing. Understand?
Understand.
Okay, so balancing here means you charge to equity. Other component equity with anything other than share capital and retained earnings, we cut under here, all the reserve. So goodwill or acquisition is unchanged. Unchanged. So this is also correct. So all of the above. Okay, good. Okay, good. Your double entry, excellent. Do exactly here. Debit bank, credit NCI, the balancing, credit to OCE. Or you debit 10 million should be, so the amount charged to OCE should be credit. Understand? Because it's just, so it's easier for you to pass the double entries. So you know whether the bank amount higher or the NCI is higher. So next one, this one is very friendly. They told you already, disposal when control is retained. So it's under here, the journal entry. So on 1st January year 2, P acquired 80% for cash. So then you have to compute goodwill, correct? Okay. And 30th June is sold 10%. So they have to draw out the simple map. So you have a P, acquire S, initially 80% in 1st January year 2. Then it's sold off 20%. So you have 60%. So it's retain control, still a subsidiary. Which date they sold off? 30th June, year 2. So you have to compute the NCI at 30th June, day of disposal. You sold 10% of equity, not 20, okay, 10%. Nobody pick up 10%, so you have 70%. Okay, this is the S. So it's a retain control. So from 80% become 70% subsidiary. So then further there's a S did not issue any share or make any distribution of its shareholding. So the share capital remains the same, unchanged. So we're not worry about the share change in share capital. So the percentage will be changed. The ownership there will change the share capital. PEO partial goodwill, they mean NCI pay on proportionate to the net asset at day of acquisition. No goodwill is attributed to NCI, which is correct, partial goodwill. So they give you the net asset of today, 1st January, year 2, 700 here. So this will help you to compute your goodwill when you first gain control in 80%, 1st January. 31st December is at the year end. So now the question is, they're asking you 30th June year, so middle of the year. Then how? So you have to proportion up your profit. So they give you a timeline. Okay, year end is 31st December year 2. So 1st January year 2. So the disposal date here, 30th June year 2. So from this date, the net asset is 700. So this is 900. So in between here is what happened? What is this? It's been 200. This must be the profit. Because the share capital no change, the July change in net asset will be retaining. So profit here will be 100 here and 100 here. So it's 6 months. So, so the profit up to 30th June is 700 plus 100. Okay. So now we go to here. So they said no impairment and decided that investment S has been impaired by 8 million. So this is at year end. The impairment of 8 million. So disposal type, subsidiary, yes, retain control, subsidiary. Compute NCI, 10% of NCI, how much? Okay, so they have to compute. So you compute correctly. Compute NCI before disposal 160, so very good. So at acquisition date, so you have 700, 20%. So on 1st January, 700 here, you have 20% NCI. So up to 30th June, you add in another 100 times 20%. Okay. 20%, so we 160. Then now you dispose of, the parent dispose of, sell 10%. So NCI bought 10%, so what? NCI increased by 80. So you mean 160 is 20%, 80 is the 10%, half of the 160. So your total up 240 or 70% NCI. Understand here?
Understand.
Okay, good. So how come we make 180? Okay.
I use wrong on the additional 10% that part.
Oh, okay. So additional, this can be quite misleading because it's 10% out of 20%. So 160 is 20%. So 10% of 160 equal to 80. Okay. So good. You got it very good. So the entry here, how come? So entry here, now we know is, okay, now we pass the entry. So NCI is 80. We use passive format as 80. So this is 10%. So then we sell it for how much? The question said for 94 million. So we receive 94 or receivable. So difference is 14. The OCE. Okay, do it correctly. It's surprising, right? If this one you do it correctly, this is NCI just after disposal. Okay. And the double entry now, you understand the double entry. You given here debit bank 94. You credit NCI 10%, 80. It's all correct. And the balancing 14 go to OCE. Oh, the benefit is not applicable. 160 million NCI. Should choose not applicable. Profit and loss is nothing to do with profit and loss because it's within control. No gain loss on disposal. Now understand?
Understand.
Good. This is clear. Accept. You equity accounting, why you say true? but still retain control at 70%. Okay, unless it's below 50 and between 20 to 50. You only use equity accounting, like the partial disposal here, you equity accounting. Okay, well done. Okay. See others, how others perform. Okay, Angelina, need improvement. See which part you're making mistake, Angelina. In-laws or disposal. Angelina, can I say to you?
Yes.
You understand why you're wrong here? The 30 just I explained already, 30 million.
Yeah, you just now explained already.
Okay, good. This one you understand. Oh, same. Okay, same misunderstanding. So this one you understand? You go to different is go to the OCE 40. Okay, it's credit to OCE. Same thing. This one you debit should credit. You credit because you buy more expensive. You pay 94 million to get over something value NCI like at 80 million. You overpay 40. Okay.
Okay.
Okay, good. NCI before disposal. Okay, same issue here. Understand here?
Yeah,
Just
yeah.
before. Okay, it's a proportion up of the 20% here. Okay. Just after disposal, same. So decide NCI is very critical. You get it wrong, the 10% here before, after, so your OCE charge balancing will be wrong. Okay, double entry. Now you understand? Angelina?
Yes.
Okay, good. I say everything true. Okay. So this is still retain control, 70% still a subsidiaries. So no gain loss on disposal. Is given here no gain loss on disposal? Goodwill first, so nothing to do with equity. Because you still have 70% here. Okay. Good try. Thank you. Okay, the rest.
Thank
okay.
you.
Very good. Li Xian, well done. You achieve half the mark is considered well done. Danny, well done. So, Qing so you need to work harder. Please redo. And this part also wrong, very serious type of disposal. Qing can I speak to you? Maybe you know here having lunch or what?
Yes, sir.
Okay, the first part, you know why you're getting wrong type of disposal?
Yeah, because of the percentage.
Oh, the 90% you sold off 50. So you have remaining 40. So it's a subsidiary become associate. Understand?
Yes, sir.
Okay, so you watch out, you get the type of disposal wrong, then you very likely that the rest of the answer will wrong because the treatment are different. Okay, so please redo these online questions. Okay, the rest good. Okay, okay, most of you. Some of you didn't do or you still doing. Jackie Kong. Jackie Kong, can I speak to you?
Yes, sir.
Profit and disposal now, I understand already? 30 million? Good. Okay, not bad, you're doing very well. Only one this is NCI, so this costing. So you NCI do it incorrectly, but your double entry perfect, Okay.
Sir, can you repeat again for the after NCI one?
Come again, can't hear you clearly. Repeat what?
The NCI after disposal.
Okay, NCI after disposal. Okay. Okay, then maybe I just show you the NCI here. So NCI normally how we compute NCI. So acquisition. So when you bring the console, then you know that acquisition with console we use the net asset here 700. So we have 80%. So NCI 20%. So 700 times. So 700 here. 20% is acquisition. And after that, we share the profit. Right? So plus post-acquisition profit. So the post-acquisition is must up to 30th June. So this is the date that we dispose of year 2. We can't use year-end one. So there's no object for it. We said we have 700 given as at year 2 opening 1st January and 900 31st December 92. So the difference must be profit. Whole year is 200. So the 200, use the 200 times 6 over 12. But the subsidiary can, the NCI can share how many percent? 20%, because 80% you own. Just before your disposal, so you have 20. Over here. So up to here, Jackie, understand? Jackie. So this is the NCI 20% at 30th June year 2. Okay. So this is before disposal. So after disposal, your NCI disposal means the parent dispose. NCI bought. NCI increase or decrease? Jackie. Dispose 10%. Jackie.
NCI increase.
Yeah, increase because the parent sold to NCI. So 2 are owner. So increase. So additions increase. So increase by 10%. So you know 20% here for 160. And 10% how much? So you 160 times 20 times 10% over 20%, 80. Agree? Agree? 10% is 80.
Yeah.
So then add the 80 here. So you sum up, it will come to after you dispose 240. Understand?
Yeah, okay, understand. Thank you, sir.
Okay. So then you can do come to year end, so you get the balance 6 months. Is it? The balance 6 months, you have another plus another post acquisition profit until 31st December. You can do that. So that will be meaning now this time not 20%, it's 30% the next 6 months. So then this is the 30,000. So just do until year end for you, so you can see. So this at 31st December to year 2. Okay. Okay, good. Double entry, excellent. Okay, most of you can follow. Okay, very good. Okay. So any particular part you want me to explain again, just let me know. Okay. So that to make sure you are better off. So I give you 2 more online questions to try out. Okay. So here I see this when control is repeated. So the double entry given here. Consider receive, you tap it. Increase the NCI, you less up, different go to OCE. Okay, so in terms of theory, so what will happen here? Okay, no change in goodwill. Okay, just a movement to the parent equity. But I send you the second set of online question. Please try out. Okay. So the more you do, the better. Yeah. So here I give you disposal control routines and the format. Okay, this is the first part here, theory. The P&L and OCI, how you do. SOFP, how you're going to do, and the format. So just how we already increase in NCI at day of disposal, after the disposal format, and the proportion. Remember just how we 10% over the 20%. You compute NCI at day of disposal. So when it comes to disposal, everything will be fair value at the day of disposal when you compute the gain loss. Okay, so try this out. So we discuss in 20 minutes time. Okay, let's discuss the online question. So apparently nobody submit, It's very bad. So you continue at home. Okay, so you read out the comments here, the summary given here, then we do it. So this time it tells you profit and loss, okay, account. So it give you three companies. MK is the parents, and EY and PP is the subsidiary. It give you the P&L, and MK owns 60%. You draw a simple group chart. MK controls 60%, so you know NCI will be 40. Okay, then you won't confuse and not keep on referring to what. So you know NCI is 40%. So then on 1st May, acquire 80% of PP. MK might acquire 80% of PP. Then purchase constraint 250. So you do your computer goodwill. And fair value of net asset 300. So NCI proportion using partial goodwill. So 20% of 360. So you have goodwill of 80 goodwill. So you must first compute the goodwill of PP first. Then now, it said they dispose of 10% equity of PP on 31st October. So year-end 31st April X3, 31st October. So different by how many months? 6 months, okay? 6 months. If you get it wrong, so your answer wrong. So you time a portion 6 months. But in this case, what type of control is retained? From 80%, you dispose of 10%. So you got 70. So you have so now NCI you're changing. Earlier you're 20%. So you plus another 10%. Now become 30% from which date? 31st October X3. So make sure you portion up and set the entire portion for the year. So NCI and proportion asset. So they have intergroup sales. So we're intergroup here. So we can't make profit out of the unsold goods. Get 12,000 at cost plus. So the unrealized profit is, so you can compute your unrealized profit, URP and URP. So 12,000. So cost plus 20%. You should ship the cost 100%. Cost plus be 120%. So 20% here. So unrealized profit will be 2K. So this one, you have to take it out from your cost of sales and your closing inventory credit. The first one here, they're asking you which of the following statement is false, the wrong statement. So when control is retained, no accounting boundary is crossed. Yeah, this is correct. Okay. Increase in NCI? Yes. Because you sell it, the parent sell, sell it to the NCI. Decrease in NCI is wrong. Okay. You can refer back to the statement. The notes are given to you 3.71 and 3.72. When the controls is retained. Okay, so actually NCI is increased, not decreased. So compute goodwill, which we have done. Okay, 250 you pay for 80%, and say 20% on the 300 net asset. So you get 10. So group revenue. So you use group revenue, console revenue, you use the MK 800, 140 for EY, 140 from P&L, 100% for the EY revenue, 100% of PP. Then you take out the intergroup sales, 12. This is 1158. Follow? So simple. Same thing for cost of sales 680. MK EY 90, PP 170. You minus out intergroup sales. You plus back unrealized profit. So when your cost of sales go up, the profit go down. Remember, plus are not minus. Intergroup sales, you're using the selling price, okay, to deduct. So the gross sales amount. Okay, the rest you can continue. Understand? Okay, the answer will be given when you submit. So some of you sitting for exam, as I say here, got 2. So we'll end this tutorial, this lecture now. Any question before I end? So they give you the homework. You can practice out. Okay, so most of you still very weak on disposal. Any questions? Okay, no question. Bye.